Guys, it's May from Markets with May, and we are going through the SBF Sam Bankman-Fried interview with New York Times Deal Book. He's being interviewed by Andrew Ross Sorkin, and we're essentially just commenting on different things that we're seeing. Given that my background, oddly enough, is actually very strong risk management. I was head of risk analytics for a bunch of hedge funds over the last decade. But I am a buy side risk person. Sell side risk is a little bit different. Still, I think that given how much jargon and how much oddness and technical stuff is in this interview, I thought it might be helpful to just try to explain where I know for a fact there's no possible way someone could have understood what he meant. Anyways, there are 3 other episodes before this that go through the first 45 minutes. We're starting around 45 minutes, 46 minutes, and we'll go about 15 minutes, and then we'll do the next episode. So let's get straight into it. Now, where we left off, he was talking about his quote unquote charity works, which essentially the only one that he actually named for the $100 million alone that he donated to the different political parties was having pamphlets in perfect English grammar. I mean, it's just so bad, so bad. All right, let's keep going.
Using your money and influence, and I think there's a question about whose money you were using, but to donate, for example, to the Democratic Party, in large part to influence regulation. And I think as people have looked through now some of the regulation you were pushing for at CFIUS, for example, some of that regulation would have allowed you, frankly, to, quote, self-certify a lot of what was going on at FTX. And there are people who look at that and say it was all part of a scheme.
So, I mean, unpacking pieces of that, when you look at like the CFTC regulation there, ultimately, there may have been an ability to self-certify contracts, but prior to that, we went through a congressional hearing, a public comment period, a public roundtable, a year of inquiries, and tens of thousands of hours, thousands of pages of submitted documents, and still had not gotten to the point of having a license to offer emergent futures in the United States. And
okay, but you blew up in a blaze of glory, so I don't know that you can necessarily say that they made the wrong call. Just saying. All right, let's keep going.
So it was an extraordinarily long and hard process that we were going through with the CFTC.
As it should be. You're an offshore bunch of sub 30-year-olds that are trying to use an asset that is currently not recognized in the United States. And you actually are doing things like what you did as relates to moving funds through Alameda into FTX. I think the CFTC was in the right.
It was by far the most intensive regulatory process that I'd ever seen.
Can you speak to the lobbying piece of it, though?
Yeah.
And the donations piece of it? Because I think that's become part of the story as to whether you effectively were influencing lawmakers to do your bidding. And given the state of your current company, questions about whether that should be the case.
So, I mean, lawmakers were not ruling on FTX. FTX didn't have an application before Congress for anything. My donations were mostly for pandemic prevention, and they were looking at primary elections where there were candidates who were outspoken in favor of doing things now to prevent the next pandemic. That was the primary thing that I was supporting with those contributions. And it was on both sides of the aisle, primarily operating in both primaries, because I wasn't viewing it as a partisan exercise. There was not, most of this was not looking at donating to one party to beat the other one in the general elections here. It was not only was it on both sides, but even within each side, it was between 2 candidates in the same party, and it was looking at pandemic policy.
Where did the money come from for those donations?
So, basically profits. I mean, it was substantially smaller than the amount of trading profits that Alameda had made over the prior few years.
Related to this, you had a meeting with Gary Gensler. You also met with folks at CFIUS. Do you think you needed to buy your way into those meetings?
I mean, I don't think I need to buy my way into them. I do think it was harder than I would have thought it would be to get to the point of being even able to have meetings with some regulators. And I mean, I spent hundreds of hours, probably thousands of hours in DC trying to get to the point where I could even have meetings with some of the relevant regulators. But that wasn't a money thing. And I mean, there's no donations to Gary Gensler's. He doesn't even have a campaign to donate to in the first place. That was like elbow grease. I mean, that was just asking again and again and again to have meetings with relevant regulators and submitting hundreds and thousands of pages of documents.
You also made big investments in a number of media companies, and I think that's raised a lot of questions about whether you were trying to buy influence. Can you speak to that?
I mean, I think media matters a lot, and I want to support good media ventures. That was the whole thesis there. And I don't have like governance over any of these. I wasn't looking for governance over them. I was looking to support journalists doing great work because I think what they do is really important. And I think that there needs to be a critical eye on stories. I'm certainly seeing, being on the getting the brunt of a lot of that right now. And, frankly, I think it's healthy for the world that there is real investigative journalism.
Your parents are law professors. What did you tell them when all of this happened?
I mean, I don't remember exactly when I reached out to them, but I think I called them up and said, "Hey guys, I think there might be a problem. Like things, looks like Almia's position might be imploding here, and there might be liquidity issues, and I'll tell you more when I know more." That's my guess about roughly what I said. But honestly, that week so much happened. It's a little bit of a blur to me exactly what.
And what are they telling you now?
And look, it's been a hard period for anyone who was close to me, and none of them deserved that. And I feel really, I mean, look, like a lot of, obviously the largest number of people who were hurt here were customers, and I feel incredibly bad about that. But anyone who was close to me, including my parents, including employees, coworkers who fought with the company to push forward, were hurt by this and bore no responsibility for that. I feel really bad about that. And I mean, I feel really grateful for the support that my parents are still giving me, throughout all of this.
Can you explain the real estate piece of this to us? I think there's been a number of headlines, as you know, about FTX, the company buying a lot of real estate up in the Bahamas. Where you lived, at least at the time, was owned by the company. But then there's also reports that your parents signed and were effectively provided with what seemed like a vacation home.
So I don't know the details of that house for my parents, but I know that it was not intended to be their long-term property. I know it was intended to be the company's property. I don't know how that was papered, and I think that was where it was and will end up. I think they may have stayed there while working, with the company sometime over the last year.
In fairness,
when you look at the rest of it,
really kind of petty to talk about this.
There were a lot
the
of property
was
purchases in the
actually
Bahamas.
making money.
The reason for that is
time.
we had, 100, basically 100 Silicon Valley, top Silicon Valley employees come down here to work for FTX. And, we were trying to incentivize them to, make sure that they had an easy way to find comfortable life.
This part I'm going to fast forward over because these little property things are not
put together
the
here,
fortune that is
really
buying
a substantial amount of property. But I feel bad about some of those investments they turn out for them.
Can we just speak to the idea of this company that, at least from the public perspective, seemed like a regulated company or something that was very focused on compliance. You would go to Washington, you talk about compliance, you talk about trust. Crypto ultimately is actually about trust. It's about not having to trust others, frankly. It's supposed to be a trustless system. That's why you trust trust it so much, supposedly. But it seems like when you read the stories, it sounds like a bunch of kids who were on Adderall having a sleepover party.
I mean, look, I screwed up. Like, I was CEO. I was the CEO of FTX. And I mean, I'd say this again and again, that means I had a responsibility. That means that I was responsible ultimately for us doing the right things. And I mean, we didn't. Like, we messed up big.
But there were people, though, who were telling you needed more compliance, no?
There were, but I think that compliance, we were spending an enormous amount of our energy on compliance. We were spending an enormous amount of our energy on regulation, on licensure. We were getting licensed in dozens of jurisdictions. I think, frankly, we were spending probably too much of our energy getting licensed in retrospect. You know, there were some places where I think that the reporting and transparency obligations from that licensure actually did help. I think when you look at, I mean, FTX US derivatives, I think when you look at FTX Japan, which I think is fully solvent, which I think could make all customers whole tomorrow if it were, if, you know, the sort of relevant teams were to allow it to. I'm confused why it hasn't. But you know, I think that a lot of what we ended up doing and focusing on was a distraction to some extent from one unbelievably important area that we completely failed on, and that was risk. That was risk management. That was, you know, customer position risk, and, you know, frankly, conflict of interest risk. And you know, there was no person who was chiefly in charge of positional risk of customers on FTX. And that feels pretty embarrassing in retrospect, because that was, you go back to 2019, even 2018 asked me, why am I starting to build out FTX? What's the point of it? And what I would have said was, look, existing crypto derivatives exchanges have large risk management failures, that every day there are millions of dollars that are being lost by customers because of risk management failures, that these contracts are paying out 75 cents on the dollar week after week after week because of risk management blowouts, and that needs to be overhauled. And that was what I was focused on for the beginning of FTX. I was not focused on that for the last year or two. I got less grounded from that, and I started focusing on the bigger picture, on you know, future business avenues, on licensure, on a lot of things. And I mean, we lost track of a really important part of the business and of the product. And so there absolutely were management failures, huge management failures. I bear responsibility for that. There were oversight failures, transparency failures, reporting, like so many things we should have had in place. I think that a lot of it was on the risk management side.
Let me ask you about.
All right. The degree to which that's not an acceptable answer is beyond. I don't even actually know how to even begin. First of all, when he's talking about compliance, he goes straight into licensing, which is not even a legitimately, I mean, yes, there is a legal team that does licensing, et cetera, but that is not what most people are thinking about as relates to compliance. If you work at an investment bank, at a broker dealer, at a buy-side firm, like any of these normal financial institutions, the bulk of risk management deals with regulatory compliance risk, which they're unregulated, so that shouldn't be the bulk of it, right? And it deals with risk management proper. What are your gross net exposures? What are the biggest risks of the firm, et cetera, et cetera, et cetera. So the fact that it took him so long to get to the punchline, because for him, compliance is about getting the proper licensing, is crazy to me. But even more than that, other thing that someone might be talking about as relates to compliance it's the stuff that he throws in right at the very, very end, which is like having the correct compliance and risk controls in place on your accounting itself. So I think it comes out in this interview and others that they didn't even really have basic accounting controls that you might expect at any company of any meaningful size. The third thing that is so troublesome about that whole conversation is the idea that he would be the one to do risk management. That's insane. There is a reason why you have a head of risk separated from everything else, and that sometimes that head of risk still gets to speak in certain meetings that you wouldn't anticipate normally the head of risk would speak at. As a true trusted advisor, that you would be the one to do both the CEO role of like managing the strategy and managing the trajectory of revenues, and the chief revenue officer, which is what he's really describing here, and risk manager without appointing someone highly competent to do any one of these roles is laughable. It's actually nothing short of laughable. It's not like you're a 5-person startup. You actually are a big company. And I think the worst part of it is what we'll talk about, what I think comes in a little bit, is that you had actual investors that should have known better, All right, let's keep going and see what's up.
Which is, we had Larry Fink here today, and he had a stake in FTX. And Sequoia and Paradigm and some very big venture capital firms had given you money. And I'm curious if they ever asked you questions about this risk management and whether they bear any responsibility for what clearly now appears, and you're saying, was at minimum a lack of oversight, if not something much worse.
Okay, I have actually watched this portion before. This portion to me is the most disturbing portion of the entire clip. Here we go.
I don't think they bear responsibility. I mean, like when you look at, you put yourself in the eyes of an investor, of a venture capital firm. What you're thinking about primarily is upside, right? What you're thinking about primarily is investing in a private company and thinking, might this 3x, might this 5x, might this even 10x on the upside cases. And yeah, there's some chance that it will go down. There's some chance that maybe it will go down to zero. But that's counterbalanced by the upside propositions here. And so most of what they were focused on was, I think like, what might FTX become? What's the pathway to get from here to there? What would it take? What are the missing pieces? Rather than, at the point where you're dwelling on all of the various precise downside scenarios and risks for a prospective venture investment, that means you're not investing. Like,
I can't even, it's such malarkey. Like, it's actually such malarkey. And the thing that's crazy about it is that, I mean, if you're a private equity guy and this is really how you guys run your firm, please put it in the comments. I would like to understand and know, because, gosh, I mean, like, I can see how that might be the case for certain types of startups, right? Where it's not a derivatives type exchange where it doesn't just go to zero, but you take on potentially a massive liability. I can't see it for a financial firm of this nature. I mean, if you just gave these guys money outright, took an equity stake, and you didn't even think about just determining whether there was even the most basic of structure in the firm to avoid, I mean, imagine too, in the last couple of years, we've had Robinhood, we've had, I guess from an equity investor's perspective, that deal actually ended up doing way better than it probably should have for what happened when it's all said and done. And then you have Credit Suisse, which has been an Archegos, which has been really fun. I mean, this is something right here.
Like, if that's where your head's at, if you think the odds are that that's where things are going to end up, why would you do that investment?
And then to have the person that you invested in, which, by the way, this is a broker, a dealer, well, actually a broker, it's an online exchange that you're essentially investing in, speak in this way. Like, what the F, with all due respect? If this is how everyone is making their investments on exchanges and you happen to be on one of these crypto type exchanges, you definitely need to review what's up on, because this type of language and way of thinking about it and his whole, like, watch how he lights up and stuff. this is, yeah.
You have tweeted about it. Caroline has tweeted about it. Others have tweeted about uppers and downers, and all sorts of things. There have been pictures taken of something called MSAM, which apparently increases levels of dopamine to the brain. It's actually for Parkinson's. Were you taking that as a patch?
So it's funny hearing this. I had my first sip of alcohol after my 21st birthday, and I think I have maybe half a glass of.
I'm going to pause there and probably skip all this silly nonsense that I think is somewhat irrelevant to the business. You know, I'll let other people cover that, but that gets us to an hour. There's one more round that we're going to do. If you have comments, I would love to hear them down below. It would be amazing if you would like, share, comment, or subscribe. And otherwise, I'll see you in the next episode.